Welcome to part 2 of our 4-part series on investor psychology and behavioral science. Today's topic will look at why investors make the decisions they do, good, bad, and ugly, and how they react to recommendations made by people so-called in the know. One of the big problems with investors is they make a decision where they're looking for a guru. Most people view investing as a sport. They're looking for a superstar to pick stocks for them. This is a very dangerous play, as only 1 in a million could be considered gurus. As you can see from this chart, there are very long-in-the-tooth market pundits that have been around for 30, 40 years, who, when they do make a call in the market, have only been right 1 out of 12 to 1 out of 8 times, which means they're wrong 11 times out of 12 or 7 times out of 8. This concept doesn't just apply to individuals, it also applies to institutions. You may recall reading about Nick Leeson of Barings Bank. He was single-handedly responsible for bringing down the bank by losing $1.4 billion while trading futures contracts. Again, don't listen to what the gurus have to say. It's more important to take the information that they're giving and relay the facts into your own investment decision-making. We are informed and opinionated. The majority of high net worth investors are very informed about world events and politics. Unfortunately, this will often influence their investment decisions. It is therefore key to remember that there is a significant difference between being informed and being truly knowledgeable. Have a look at the 4 indices below. Since 1990, if you had invested $1 Canadian in the TSX, it would be worth $3.51 today, almost 18 years later. The Europe 50 at $3.90, the S&P 500 at $3.41, and look at that Mexican bolsa, the Mexican stock market at $14.93. If you would put all your money into the Mexican market in 1990, you'd be up almost 14-fold. However, and here's the caveat of being informed, is that in 1993-94, when the peso fell 70%, so did the stock market. It's very important that if you had $1 million and were taking out $75,000 a year to live on, by 1997 you'd have had no money. So you would not have been able to involve yourself in all of the run-up of the Mexican market. So again, it's very important to be informed as to what each index is doing and why it's doing what it's doing. And also remember that the way to manage that kind of risk is to stay diversified. I'll buy the fund that was the best performer for the past 10 years. While investors read in the fine print of an advertisement or prospectus that past performance is not indicative of future results, they still prefer to ignore this advice. As individuals, we always tend to look backwards when making our decision-making, and that is the wrong way to think. We usually buy the fund that was the best performer for the past 3, 5, or 10 years. The best example there was Frank Mersch when he was at Altamira. In the early 1990s, was making 20% a year compound annual gains. But remember, the size of his fund was very small. As he started to show those banner returns and investor money piled in, then the fund grew to over $1 billion. And instead of being able to buy and sell the stocks that he wanted to own, he had to trade like the market and therefore started getting investor returns like the market. The problem is that with those kinds of returns, if he wanted to do better, he had to take on more risk. And he eventually got caught by the OSC and the BC Securities Commission for front-running gold stocks and was suspended for 2 years. Instead, it's more important for investors to pay attention to the management approach, their investment philosophy, and how big or what size the fund is and whether it will be capped or not. But more to the point is that you should find an investment manager who is aligned to what your needs are, who has a similar style and philosophy if you are investing your own money. We make the mistake of listening to our friends. Have you ever gone to the cocktail party where everybody wants to sit there and tell you about all the great returns that they've made? The one thing that I like to ask at a cocktail party is, tell me about your losers. Usually within 10 minutes, I'm standing in the corner by myself with a glass of wine, because nobody wants to talk about the mistakes that they've made. Dalbar Inc. is a US firm that did a study between 1984 and 2002 And while the S&P 500 was up 12%, the average US equity do-it-yourselfer earned only 2.6%. And the reason behind it was that they were being held back on making mistakes of buying stocks in the news, but also trading too actively, and the transaction costs and the taxes really cut back on the returns that they could have made. They'd been much better off if they just owned a US index fund. So ends part 2 of our 4-part series. Remember, the bottom line is, as an investor, leave your emotions at the door. Make your decisions based on what your investment goals and needs are, not what your neighbor is trying to do, and also not trying to chase or follow the herd of what the past winners were, because we don't know that the winners of the past are going to be the winners of the future. In our next part 3 of our 4-part series, we'll look at investment risk and how to think about risk when making your investment decisions.